Imagine this pitch document landing on your desk. It's for a tiny sovereign principality right up in the Pyrenees.
Mm.
It's politically stable. It has this stunningly high standard of living. We're talking the 16th richest country in the world by GDP per capita, almost 50,000 US dollars.
Which is incredible.
It's incredible. And the population, almost 100% digitally connected, 95.5% internet penetration.
Right.
And here's the real kicker. The corporate tax rate is a flat, ultra-competitive 10%. I mean, on paper, it just screams success.
It does.
It looks like the absolute perfect, wealthy, low-tax entry point for any serious iGaming operator trying to get a foothold in Europe.
It's the perfect fiscal mirage, and that's exactly why it demands this kind of forensic analysis.
Right.
We're the Gambling Databases research team. We're a group dedicated to delivering in-depth analyses of the global iGaming landscape.
Mm-hmm.
In each country-specific report, we explore these key aspects like local regulations, taxation, player experience, operator conditions, all the emerging trends.
A full picture.
The whole picture, yeah. Our goal is to provide a clear, data-driven understanding of how the gambling industry functions within each market and, well, what makes it unique.
And our mission for this analysis is to really test that hypothesis from the sources. Is Andorra a high-reward niche for smart money, or is it an investment trap? Are there catastrophic flaws just hiding under the surface waiting to, swallow the unprepared?
We're going to dig into the contradictions.
Let's do it.
Okay, so let's start where everyone starts, with the balance sheet.
Yeah.
When you look at the financials, what are the absolute biggest draws, especially for an operator used to harsher taxes?
It's the combination of market affluence and fiscal leniency. That combination is just uniquely powerful.
So that GDP figure, the $49,000.
That GDP per capita figure, 49,304 USD, is staggering. I mean, to put that in perspective for you, it puts Andorra above major economies. Think Germany, Canada, in terms of wealth per person.
Wow.
It's a huge signal that residents have exceptionally high disposable income. And a big part of that is the personal tax structure, right? They get to keep more of their money.
Precisely. The personal income tax there is minimal. It runs from 0 to a maximum of 10%, and the first $24,000 is completely exempt.
So unlike a lot of Europe.
Exactly. Unlike many markets where taxes just eat into spending power, Andorran residents retain a lot of funds. Now, for the operator, that corporate tax rate is a standard 10%.
Which is so low.
It's incredibly low. If you compare that to, say, France, where you're looking at around 25%, or Germany, where effective rates can be even higher, 10% is a massive, massive incentive.
And that's just the corporate side. The gambling-specific taxes, are they also competitive?
They're intended to be, yeah. The framework is designed to keep gambling taxes, and this is the quote, really low. When you factor everything in, the analysis suggests an estimated effective tax rate for a licensed operator would be in the, say, 18 to 25% range overall. And that is extremely competitive on a global scale. If you're a big international operator trying to maximize your margins, seeing a total tax burden under 25% in a developed, wealthy European country, it's intoxicating.
And beyond the tax, the consumers themselves they're completely ready for a modern digital product. That's another huge plus.
Absolutely. The population is technically very sophisticated. You have 95.5% internet penetration, and that's backed by smartphone adoption that's estimated to be over 95%.
No?
This isn't a market you need to educate on mobile payments.
No.
But the one metric, the one that lets operators kind of ignore the elephant in the room, the tiny number of residents, that's the tourism factor.
It's a tourism factor. It's always cited as this great market multiplier. Can we quantify that?
It is numerically massive. Andorra gets about 10.8 million tourist visitors a year.
10.8 million.
Yes. And that figure is literally 130 times the entire resident population.
Right.
So for many operators modeling their entry, they are completely dependent on converting a tiny percentage of those millions of visitors into gamblers. It's the only way to scale the revenue.
Okay, so the financial profile is exceptional strong, low tax, high wealth, digitally savvy. But that raises the big question, the key to our analysis. If the money looks this good, why isn't the market already saturated?
Exactly.
The contradiction has to be in the legal structure, right? The application of that law for 2021. What does the regulatory landscape actually look like on the ground?
Well, the legal foundation is solid. Law 4/2021, passed back in March 2021, set up the whole framework for land-based and online gambling. It's all overseen by the CRJ, the Council Regulator Andorra del Joc. The framework is there.
But the implementation.
The implementation that has been defined by, well, local favoritism and regulatory inertia.
Let's start with the clearest signal of that, of the protectionism, the land-based casino license.
That is the crucial nugget. The sole 17-year Class A casino license went to a company called Jocks S.A.,
And they are.
a 100% Andorran-owned company.
Okay.
And this wasn't a soft competition either. They were up against international heavyweights like Genting Group.
The Malaysian conglomerate.
Exactly, known for massive integrated resorts, and Sursa, one of Spain's largest gambling operators. These are companies with billions in capital and decades of experience.
And the local Andorran company won. That speaks volumes. What does that tell a foreign operator?
It sends a clear, unmistakable message. Foreign capital faces a massive, maybe insurmountable competitive disadvantage when it comes to getting premier licenses. Local ownership was prioritized. It suggests a protectionist streak that's going to make it extremely difficult for any non-Andorran company to compete.
So even if you set up a local company, the path to a license is immediately precarious.
Mm-hmm.
But what about online? That's where the real high-margin, scalable action should be.
And that brings us to what we call the online vaporware problem. The law explicitly authorizes the CRAJ to issue online licenses. Yet here we are in early 2025, 4 years later, and the CRAJ has issued almost zero comprehensive online licenses. The government built the framework, but the practical implementation is just stalled.
Which creates huge uncertainty.
Massive regulatory uncertainty. You can't risk tens of millions of euros on a market where the regulator just refuses to pull the trigger on the actual licensing.
And if that wasn't bad enough, there's no barrier to entry for the existing gray market.
That is the competitive death blow. Andorran residents can, right now, access Bet365, 888, all the big international sites, completely freely.
Freely.
And here's the critical part. CRAJ has implemented zero ISP blocking, zero payment restrictions against these offshore, unlicensed companies.
That puts any licensed newcomer in an impossible position.
Absolutely impossible. If you launch an operation, you're bearing all the local compliance costs, the fixed operating cost, the 18 to 25% effective tax rate. But you have to compete for the same small pool of players against global brands with zero local tax burden, zero compliance costs, and infinitely larger marketing budgets. It is an unwinnable fight.
And for anyone even considering investing, you just have to look at the history of their decision-making. It hasn't been a smooth ride.
Not at all. The regulatory flip-flop on that casino license is a perfect example of the investment risk. Jocks S.A. won the tender in 2018, but then the license was withdrawn in 2019.
Withdrawn.
Then it was re-awarded after appeals, only to be rejected again by a legal challenge in 2020 before finally getting approved much later.
That's a night.
That kind of unpredictable back-and-forth saga, it signals significant judicial and political friction. It adds years to your timelines and dramatically increases your cost of capital.
Okay, so we've established the political and regulatory friction, but hang on. If the initial numbers, the low tax, high wealth, were so attractive, there must be an ultimate structural Achilles heel that just destroys the financial model. We have to pivot to the financial arithmetic, because the core analysis suggests the simple unit economics are just impossible.
We're moving from risk analysis now to financial catastrophe.
Yeah.
And it all starts with the foundational problem, the extreme micro-market size.
Right.
The total population of Andorra is only 82,904 residents.
82,000.
That number.
Yeah.
That is the gravity well that pulls down every single profitability calculation. It is smaller than a typical mid-sized European town.
Less than 83,000 people. That is your entire resident consumer base, no matter how rich they are.
Exactly. Now, let's look at the cost side. Operators, no matter the market size, have a significant fixed cost burden. We estimate annual operating costs, staff, local presence, compliance, tech maintenance are somewhere between $350,000 and $800,000
Annually.
annually. You just can't scale down compliance and operational costs forever.
So if an operator's spending, say, €500,000 just to keep the lights on, how much revenue do they need to generate just to clear that hurdle?
Okay, so let's define a key term for clarity. GGR, gross gaming revenue. This is what the operator keeps after paying out winnings, but before their costs and taxes.
Got it.
To cover those fixed costs, plus the 18 to 25% tax rate we talked about, an operator needs to generate gross gaming revenue between 1 and 2.5 million euros a year.
Just to break even.
Just to get to zero. That's a massive initial hurdle.
Okay, now let's put that break-even figure up against the actual market potential. What is the maximum GGR possible from those 83,000 wealthy residents?
And this is the fatal calculation. based on realistic assumptions about market penetration. Say 10 to 15% of residents actually gamble, and average spending. The total resident market potential is only 4 million to 12 million annually.
Wait, total.
That's across all OLL products and all operators.
So if the absolute max the entire country can generate is 12 million in GGR, and a single operator needs maybe 2.5 million just to break even, that means you need an impossibly high share of the market just to survive.
Correct. You would need to capture and then defend anywhere from 20% to 60% of that entire tiny market. Our analysis deems this impossible.
Impossible.
Especially when you factor in the unrestricted global offshore brands like Bet365 already servicing the market. The economics do not support local competition. This market is guaranteed to destroy value for anyone trying to operate on standard margins.
And historically, the whole reason to set up in a microstate with low taxes was to use that license to access bigger markets. But that strategy completely fails here.
That's the most crucial geopolitical trap. Andorra is absolutely not an EU member state.
So no passporting.
An Andorran license gives you zero ability to serve larger EU markets like Spain or France. You are permanently trapped serving those 83,000 people. The strategy works in Malta or Gibraltar. Here, it is dead on arrival.
Which brings us back to the 10.8 million tourists. That has to be the only way to close this massive gap between market potential and fixed costs. Is it a realistic safety net?
It's a complete reality check.
Yeah.
Yes, 10.8 million tourists visit, but their main reason is skiing and duty-free shopping.
Not gambling tourism.
Not at all. The analysis suggests that realistic gambling conversion rates among those tourists are minimal. Tourism revenue is likely to add only, say, 5 million to 15 million to the total market. That's nowhere near the scale you'd need to make a €500,000 fixed-cost operation reliably profitable.
So you might cover some costs.
You might cover a fraction of your costs, sure.
Okay.
But you will not achieve a sustainable return on your investment.
So if you connect all of this to the bigger picture, the contradictions just overwhelm the initial promise, don't they?
They absolutely do. The overall market attractiveness rating for Andorra is low. It scores just 3.5 out of 10 in our analysis.
Wow.
That lethal combination of high fixed costs, an 83,000-person market, and fierce, unregulated offshore competition. It means this market will almost certainly destroy value for 99% of operators.
So what does all this mean for you, for anyone listening to this analysis, who should absolutely steer clear of this principality?
You should definitely avoid Andorra if you are any operator seeking reliable near-term ROI. You should avoid it if you're a foreign-owned company expecting fair or competitive licensing. That JOC's SA precedent is a huge warning.
Huge red flag.
And you must avoid it if you're an online operator expecting to use that license to access the wider European market. You will be trapped in a loss-making micro-market.
So is there anyone for whom this might still make sense?
Only two very specific groups. First, 100% Andorran-owned entities with strong local political connections. They have the only realistic path to getting those future online licenses.
Right.
And second, maybe a major international land-based conglomerate with vast resources. We're talking €15 plus in capital, who are focused only on the tourism sector and are willing to treat this as a long-term prestige project. A 10 or 15-year investment horizon, not a standard profit center.
It's a beautiful place, but a financial quagmire for iGaming investors. So let's end with one final provocative thought for you to consider. Given that the maximum personal income tax on gambling winnings is only 10%, and the first 3,000 of winnings from licensed venues is completely tax-exempt, is the real reliable opportunity here, actually, for the highly affluent player seeking a low-tax place to cash out their wins, rather than the operator trying to turn a profit, something to mull over.
A very interesting thought.
For the full text of this and other country reports, visit our website at gamblingdatabases.com.